All right, let's dive into the world of dividend stocks, specifically in this kind of crazy economic climate we're seeing in 2025.
Yeah, it's definitely giving everyone some serious 1970s flashbacks.
Totally. It's like we're stuck in an economic time warp back to the days of bell bottoms and disco, but with a side of stagflation.
Yeah, it's more than just a vibe though. We're really seeing some economic indicators that are pretty darn similar to the 1970s.
Like on repeat or something.
Yeah.
So for those who weren't around for the economic turmoil of the 70s, can you give us a quick breakdown of what stagflation actually is?
Yeah. It's well, stagflation is basically like a really bad combination of things. You've got stagnant economic growth, so the economy isn't really going anywhere.
Right, right.
But then you've also got high inflation, so prices are going up like crazy, and then to top it all off, you've got high unemployment.
Yeah, it's definitely not a party anyone wants to be at.
Yeah.
And with these echoes of the 70s happening now, it makes sense that people are looking for ways to protect their investments, right?
Absolutely.
Yeah.
People are worried.
Yeah. And our sources seem to be pointing towards dividend stocks as a potential safe haven, particularly those with a solid history of stability and growth. Can you unpack that a bit for us?
Yeah, so think of it this way. If growth stocks are kind of struggling, which they often do in this kind of environment with rising interest rates,
Right.
well, where do you go for some stability in income? That's where dividend stocks come in. They can provide a consistent income stream, which can be a real lifesaver when everything else feels like it's all over the place.
It's like having that financial anchor in the middle of a storm. Okay, so it's not just about, riding out the storm, but maybe even finding investments that could do well in a stagflationary environment. Our sources highlighted a few sectors that actually performed well during the 70s, and experts seem to think that they could do it again. So let's start with utilities, the essentials, electricity, water, gas.
Hmm.
What makes them attractive during times like these?
Well, think about it. No matter what's going on in the economy, people still need to, keep the lights on. They need water. They need gas to heat their homes. These are like the essentials, the non-negotiables. People can't just cut them out of their budgets.
Right, exactly. But it's more than just necessity, right? They have something called regulated revenue streams, which sounds a bit technical.
Yeah.
How does that factor into their appeal for investors?
It's actually it's a really good thing. Regulated revenue means that these companies have, they tend to have more predictable income because their rates are set by government agencies, so it adds a layer of stability, which is really attractive when the market is, as unpredictable as it is right now.
So it's not just about, keeping the lights on. It's about the structure of these companies.
Yeah, exactly.
Okay. Our sources also mentioned a few specific companies, Consolidated Edison, Duke Energy, and NextEra Energy as potential strong players in this space. What are your thoughts on those?
Those are some of the names that come up a lot. Each one has its own strengths. Consolidated Edison, for example, has a really long history of dividend payments, which can be a good sign of stability.
Right.
Duke Energy is another, well-established company with a pretty diverse portfolio of assets. And then NextEra Energy is interesting because of its focus on renewable energy, which could be a really big growth area, even if the economy isn't doing so hot.
Right. So it's a mix of, the reliable dividend payers and those that are tapping into that growing demand for renewable energy. Okay. Let's move on to the next sector that seemed to do well during the 1970s, consumer staples.
Uh-huh.
I have to admit, this one kind of surprised me. Why would companies that make, everyday stuff like toothpaste and toilet paper thrive when the economy's struggling?
Well, even when people are trying to cut back on spending, they still got to buy things like food, drinks, and basic household goods.
Right.
It's not like they can just stop brushing their teeth.
Okay, so we might hold off on, vacations or that fancy new gadget, but we can't really avoid buying toothpaste or toilet paper.
Exactly. And here's what makes it even more interesting. A lot of these companies have what's called pricing power, which means that they can raise prices without seeing a huge drop in demand.
So they have some wiggle room in a market where prices are generally going up.
Yeah.
Our sources specifically called out Procter & Gamble, Coca-Cola, and PepsiCo as examples in this sector.
Yeah, those are some of the big ones. Think about all the different products that Procter & Gamble makes, everything from diapers to detergent. People always need those things.
Right.
And Coca-Cola and PepsiCo. Well, even when times are tough, people are still going to want their sugary drinks.
It's like comfort food, but for your portfolio.
Mm-hmm.
All right, so we've got utilities and consumer staples. Now, this next one might raise a few eyebrows, especially considering what happened back in the 70s.
Yeah.
Energy. Can you help us make sense of this one?
So yeah, the 70s were they were definitely marked by that energy crisis, but it's important to remember that crisis also led to some big profits for energy companies.
Right.
And while things have, changed since then, the potential for energy companies to benefit from inflationary pressures is still there.
So we're not just talking about, your traditional oil and gas companies.
No, not necessarily. Companies that are involved in renewable energy could also see some benefits.
Oh, okay.
Think about the demand for alternative energy sources as those traditional energy prices keep going up.
Right. Right. Okay. So it's a much more diverse energy landscape than it was back in the 70s.
Huh.
Are there any names in this sector that stand out?
On the traditional side, you've got ExxonMobil and Chevron. Both of those have, they've got a history of paying dividends and adapting to changing market conditions.
Yeah.
And then there's Enbridge, which is more focused on, energy infrastructure. They operate pipelines and storage facilities all over North America, which could be pretty crucial as the demand for energy just keeps going up.
Got it. So we've covered utilities, consumer staples, energy. What else is on our list of potential winners in this stagflationary environment?
Healthcare.
Oh, healthcare. Okay.
Yeah.
Why healthcare? I mean, people get sick regardless of what the economy is doing.
Exactly. People still need medical care. They still need medications no matter what's happening in the stock market. It's one of those things that people can't really cut back on.
That's a really good point. And like utilities, healthcare companies are often known for paying out those reliable dividends, right?
Yeah. Oh, absolutely. And some of the major players in this space, like Johnson & Johnson, Pfizer, and AbbVie, they have a long, long history of consistent dividends and strong performance. They're often seen as more stable investments, especially when things are a little shaky.
So it seems like there's a common thread here. We're talking about sectors that provide essential goods and services, things that people need no matter what the economy is doing.
Right.
So we've got 4 sectors that could potentially weather a stagflation storm: utilities, consumer staples, energy, and healthcare.
Mm-hmm.
Is there a fifth?
There is. Real estate investment trusts, or REITs for short.
REITs. Okay. How do those fit into all this? I know they're connected to real estate, but what makes them potentially good investments during a period of stagflation?
Well, REITs own and operate income-producing real estate, and they're actually legally obligated to distribute a big chunk of their earnings as dividends.
Oh, interesting. So you're getting that consistent income right from the start. But what about inflation? How do they hold up against that?
Certain REITs, especially those with properties in high demand areas, or those that can raise rents as inflation goes up, they can be a really good hedge against inflation. Think about it. As prices rise, so does the value of their real estate holdings.
Okay. So they've got that built-in mechanism to keep up with inflation, which is pretty attractive in this kind of environment.
Exactly.
Any specific REITs that we should be keeping an eye on?
Some of the names that you'll hear a lot are there's Realty Income, which is known for its monthly dividend payouts.
Oh wow, monthly.
Then there's American Tower, which owns and operates cell towers, which are pretty essential in our increasingly connected world. And then there's Prologis, which is a big player in logistics real estate, and they benefit from the growth of online shopping.
Okay, so we've covered a lot of ground here. 5 potential sectors to watch in a stagflationary environment: utilities, consumer staples, energy, healthcare, and REITs. It's a It's a lot to take in. Where do we go from here?
Well, remember, this is just a starting point. It's like we've given you a map, but now you got to go out and explore the territory yourself.
Right.
So look into those specific companies that we've mentioned. Do some digging into their financials and see if they really fit with your own investment goals and your risk tolerance.
It's like we're becoming economic detectives.
Yeah.
We've got our magnifying glasses, our list of suspects, and now we got to gather the evidence to see if they're a good fit for our portfolio.
Exactly. And remember, there are resources out there to help you with your investigation. Financial news websites, reputable investment publications, even podcasts like this one.
That's true. Speaking of valuable insights, any parting words of wisdom for our listeners as they begin their stagflation investment journey?
A few things to keep in mind. First, stay curious. The economic landscape it's always changing, so keep learning and be ready to adapt your strategies. Second, don't let your emotions get the best of you.
Right.
Fear and greed can lead to, they can lead to some rash decisions that can really mess up your long-term goals.
So stay calm, stay informed, and stick to the plan.
Exactly. And finally, remember, you don't have to do this alone. Don't be afraid to ask for advice from financial professionals you trust. They can give you guidance and support as you navigate these choppy waters.
That's good advice. Well, we've gone deep into the world of dividend stocks in a stagflationary environment. We talked about the sectors that might hold up well, unpack risk management, and emphasize how important research is, and having a personalized investment strategy. Hopefully, you're feeling a little bit more prepared to make those informed decisions about your investments, even with all this economic uncertainty.
Remember, knowledge is power.
So true. And by staying informed and proactive, you can weather any storm that comes your way.
Absolutely.
Thanks for joining us on this deep dive. We'll be back soon with another fascinating topic. Until then, happy investing.
Happy investing.
You mentioned some pretty big differences between the stagflation of the 70s and what we're dealing with now. What do you think is the most significant difference?
Well, technology's got to be up there.
Yeah, that makes sense.
I mean, in the 70s, technology was really just kind of starting to emerge, but now it's like everywhere. Every part of our lives, every part of the economy, it's all connected.
Right. Think about e-commerce, AI, automation, all that stuff.
Mm-hmm.
It was barely a blip on the radar back then.
Yeah.
How do you think those advancements could impact how stagflation plays out this time around?
Well, they could actually help, soften the blow a little bit.
Okay. Interesting.
Take automation, for example. It could help with labor shortages, and rising labor costs, which are two of the big drivers of stagflation.
Right.
And then e-commerce, that could make supply chains more efficient, which might help smooth out some of those disruptions that lead to price spikes.
So technology could be a bit of a wild card then.
Yeah, exactly.
Okay, so what else is different this time?
Globalization.
Globalization, okay. How so?
Back in the 70s, the world was, it was a lot less interconnected. But today, we've got this highly integrated global economy, and that can actually both make inflation worse and help to alleviate it.
So it's kind of a double-edged sword.
Yeah, it really is.
Can you give us an example of how it could, play both sides?
Sure. On the one hand, global supply chains are more vulnerable to disruptions, like we saw with those pandemic lockdowns and some of the geopolitical stuff that's been going on.
Right.
And those disruptions can cause, shortages and those crazy price hikes.
Yeah, like that semiconductor shortage that's been affecting everything.
Exactly. But on the other hand, globalization also means that businesses have, they've got more options when it comes to sourcing stuff. So they might be able to find suppliers in places with lower costs or, places that are a little bit more politically stable. And that could help, take some of the sting out of inflation.
So it's a more complex situation than it was back in the 70s. More interconnected, more opportunities, but also, more risks.
You got it.
And that makes it even more important to be really picky and strategic about our investments.
Yeah, definitely.
Okay, so we've got technology and globalization. Are there any other major differences between today's economic environment and the 70s?
The role of government and central banks.
Okay, that's a big one.
Yeah.
How is it different now compared to back then?
In the 70s, people really believed that governments could, could control the economy. But
Right.
then stagflation hit, and it kind of shook that confidence. Governments had a really hard time finding that balance between boosting growth and keeping inflation under control.
It's like they were stuck in a tug of war and nobody was winning.
Yeah, pretty much. And today there's a lot more, a lot more skepticism about government intervention, especially when it comes to, to controlling inflation. Central banks are the ones who handle monetary policy, and they're walking a really fine line right now, trying to tame inflation without accidentally tipping the economy into a recession.
So there's more uncertainty now about how governments and central banks will react, if we really do enter a period of stagflation. And that uncertainty, well, that makes it a lot tougher for investors.
Definitely does. It makes it harder to predict, how the market's going to react and which investments are going to come out on top. We're in uncharted territory to some extent.
Okay, so to recap, we've got some parallels to the 70s, but today's economy is being shaped by some very different forces. Technology, globalization, and a changing role for governments and central banks.
Exactly.
So with all that in mind, how do we even begin to approach investing in this, this kind of environment?
Well, the key is to be balanced, to be informed. Don't just chase the latest trends, and don't assume that because something did well in the past, it's going to do well now. Do your research, really understand the companies you're investing in, and think about how they might be affected by these unique challenges we're facing.
So knowledge is our best weapon.
It really is.
Speaking of weapons, what about managing risk during stagflation? That can be a pretty scary topic for a lot of people, especially when there's so much uncertainty.
It's definitely understandable to feel a little overwhelmed. But remember, we can break this down, we can make it manageable. When it comes to managing risk during stagflation, there are a few things that are really important. You got to understand your own risk tolerance, you got to diversify your portfolio, and you got to have a clear investment strategy.
Okay, let's take those one at a time.
Yeah.
Let's start with risk tolerance. What does that even mean, and how do we figure out, what ours is?
So risk tolerance is basically about how much volatility you're comfortable with. Some people, they love the roller coaster ride of the stock market.
Right, the adrenaline junkies.
Exactly. But others, they prefer something a little smoother, a little more predictable.
So it's about knowing yourself
Yeah.
and, how you react when things get a little crazy.
Yeah. You don't want to invest in something that's going to keep you up at night,
Absolutely. But how do we figure out our risk tolerance? Is there like a test we can take or something?
There are some questionnaires and tools online that can give you an idea, but it's also about, looking inward a little bit. Think about your past experiences with investing,
Yeah.
How did you feel when the market took a dip?
Right.
Did you panic and sell everything, or were you able to stay calm and ride it out?
Yeah, that's a good point. Okay, so we've got risk tolerance figured out. Next up is diversification. We hear that word all the time, but how does it actually help, manage risk during stagflation?
It's all about not putting all your eggs in one basket,
Yeah, right.
In a stagflationary environment, some sectors do better than others, like we've been talking about. So if you spread your investments around different asset classes, different sectors, even different countries, you're basically creating a safety net for yourself.
So even if one part of your portfolio is taking a hit, another part might be holding steady or even growing.
Exactly.
But how do we actually go about diversifying in a way that, that makes sense for us? It seems like there's so many options.
There are a ton, and that's where having an investment strategy comes in.
Okay, so what does that involve?
It's about defining your goals. What are you trying to achieve? Are you looking for long-term growth, or do you need some short-term income, or maybe a little bit of both? Once you know what you're aiming for, you can start putting together a portfolio that aligns with those goals.
So it's like having a roadmap for your investments.
Yeah, exactly.
But creating an investment strategy can be, it can be a lot. Where do we even start?
A lot of investors feel that way. And honestly, it's often a good idea to talk to a financial advisor.
Yeah.
They can help you figure out where you stand financially, understand your goals, and come up with a strategy that fits your needs and your risk tolerance.
So it's not about going it alone.
Yep.
There are experts who can help us create a plan that works for us. But even with a solid plan, investing during stagflation, it can be an emotional roller coaster. Any tips for staying the course and not letting those emotions take over?
The most important thing is to remember that, investing is a long game. It's easy to get freaked out by those day-to-day ups and downs. But if you've got a well-thought-out strategy, the best thing you can do is just stick with it.
Easier said than done sometimes.
I know, but it's about focusing on the long term, Don't let those little bumps in the road throw you off track.
Okay, so we've covered risk tolerance, diversification, having a plan, and staying the course. Anything else we should keep in mind when it comes to managing risk, as we wrap up this part of our deep dive?
Stay informed.
Okay.
The economy's always changing, so the more you know about what's going on, the better decisions you'll be able to make. Read financial news, follow expert analysis, and don't be afraid to ask questions,
Knowledge is power, right?
Absolutely.
Thanks for breaking all of this down for us.
Yeah.
In a way that's easy to understand.
Happy to do it. It's important to demystify these topics and give people the tools they need to take control of their financial future.
I agree. All right, so we've talked about the sectors that could do well during stagflation, and we've talked about how to manage risk in this kind of economy. But with all this talk about risk and uncertainty, it's easy to feel a little overwhelmed. Where do we even start to put all of this into practice?
Yeah, I get it. It's one thing to understand the ideas, but actually putting them into action, that's the tricky part. But remember, investing isn't about finding some magic formula that works for everyone.
Right.
It's about creating a plan that works for you, your situation, your goals, and your risk tolerance.
So should we be running out to buy up shares of, utility companies and all those consumer staple giants?
Not so fast.
Okay.
Remember all that talk about due diligence?
Yeah.
Well, now's the time to put it into practice. We've highlighted some sectors and companies that might be, worth a look, but you got to do your own research.
Right.
Dig into their financials, see how their businesses work, and decide if they really align with what you're trying to achieve.
It's like we're economic detectives.
Exactly.
We've got our clues, our list of potential investments, and now it's time to gather the evidence and see if they're a good fit for our portfolio.
I like it. And remember, there are resources out there to help you with your investigation, like financial news websites, investment publications, even podcasts like this one.
That's true. Speaking of insights, any final words of wisdom for our listeners as they start to navigate this whole stagflation thing?
Sure. A few key things. First, stay curious. The economy is always changing, so, keep learning and be flexible. Second, don't let your emotions get the best of you. Fear and greed, they can lead you to make some bad decisions.
So stay calm, stay informed, and stick to the plan.
Exactly. And last but not least, you don't have to do this alone. If you need help, talk to a financial advisor you trust. They can help you through these challenging times.
That's great advice. Well, I think we've covered a lot of ground here. We talked about dividend stocks, stagflation, risk management, and the importance of having a plan. Hopefully, you're leaving this deep dive feeling a little more confident about navigating these uncertain economic waters.
Remember, knowledge is power.
Couldn't have said it better myself. And by staying informed and being proactive, you can handle whatever comes your way.
Absolutely.
Thanks for joining us on this deep dive. We'll be back soon with more insights and more deep dives into the world of investing. Until then, happy investing.
Happy investing.
Okay, so we've talked about the sectors that could do well during stagflation and how to manage risk in this kind of economy. But with all this talk about risk and uncertainty, it's easy to feel a little overwhelmed. Where do we even start to put all of this into practice?
Yeah, I get it. It's one thing to understand the ideas, but actually putting them into action.
Mm-hmm.
That's where it gets a little tricky. But remember, investing isn't about finding some, magic formula that works for everyone. It's about creating a plan that works for you, your situation, your goals, and your risk tolerance.
So should we be running out to buy up shares of, utility companies and all those consumer staple giants?
Not so fast. Remember all that talk about due diligence? Well, now's the time to put it into practice. We've highlighted some sectors and companies that might be worth a look, but you got to do your own research.
Okay.
Dig into their financials, see how their businesses work, and decide if they really align with what you're trying to achieve.
So it's like we're economic detectives.
Exactly.
We've got our clues, our list of potential investments, and now it's time to gather the evidence and see if they're a good fit for our portfolio.
I like it. And remember, there are there are resources out there to help you with your investigation, like financial news websites, investment publications, even podcasts like this one.
That's true. Speaking of insights, any final words of wisdom for our listeners as they start to navigate this whole stagflation thing?
Sure. A few key things. First, stay curious. The economy is, it's always changing. So keep learning and be flexible. Second, don't let your emotions get the best of you. Fear and greed can really, they can lead you to make some bad decisions.
Stay calm, stay informed, and stick to the plan.
Exactly. And last but not least, you don't have to do this alone. If you need help, talk to a financial advisor you trust. They can help you through these challenging times.
That's great advice. Well, I think we've covered a lot of ground here. We've talked about dividend stocks, stagflation risk management, and the importance of having a plan. Hopefully you're leaving this deep dive feeling a little more confident about navigating these uncertain economic waters.
Remember, knowledge is power.
Couldn't have said it better myself.
Yeah.
And by staying informed and being proactive, you can handle whatever comes your way.
Thanks for joining us on this deep dive into dividend stocks in a stagflationary environment. We'll be back soon with more insights and more deep dives into the world of investing. Until then, happy investing.
Happy investing.